Hi there, it's Chris Conroy with Insurance Agency Marketing Services at Omaha. Got a great lineup today of some speakers and opportunity to hear from, some of the most experienced experts we have in the industry. So this is Chris Conroy. I head annuity sales here at Insurance Agency Marketing Services. And first, we're going to hear from Matt Sabala. Matt is one of our senior annuity sales directors. Welcome, Matt.
Thanks for having me.
Yeah.
Excited to talk about what we've got to discuss with you all today.
Yeah. So, and also pleased to be joined by Ed Tom, a kind of featured keynote today, who's our Senior Director of Derivatives Market Intelligence at Cboe, which back when I was in Chicago there, whatever, eons ago at college, Northwestern, I think they called it the Chicago Board Option Exchange, but that changed, right, Ed? So,
Yeah.
So, Cboe, as a lot of people I think probably know, but if you don't know, is the originator of the Cboe Volatility Index, the VIX. Thank you, Ed, for joining us today. I know you're going to be talking about the VIX and also the VIVIX of kind of what the future, implied looks like, right?
That's right. Yeah.
Great. And then, we're gonna be talking about, what does that mean, for the producers that are out there? We got so many people that use the S&P 500, for example, and what that means on pricing and caps and pars. I know, Matt, we wrote a white paper about that with the lowering interest rates recently, right?
Yeah, we had a lot of people very interested in that. You bet.
Yeah, so we got a really good, got a kind of piece to talk about that. But, we are at an interesting time on the VIX, as I know Ed's going to share with us. And then we also have Kent Jackway. Kent's one of our preferred partners. I don't know, I call it on the technology front, but you're a marketer, right, Kent?
Yeah. I'm a marketer converted to technology. Yes.
So Kent's got Indexializer is kind of the headline name of the product we've got on board with him, and I don't know, we probably have 80 or 100 producers that are using it. Great opportunity to get a discount on that too, by the way. So we'll hear Kent, and then kind of put it all together. I think, Matt, you're going to bring us home with hey, based on what we heard today, what does this mean day to day? What do we got to look forward to with regard to especially S&P bars and caps? And we got a great solution at the end. So we've got an excellent topic today with volatility, elections, all kinds of things going on. I think obviously a lot of people work with their customers. They're looking for some certainty. They're looking for, how do we protect that hard-earned retirement savings and, just put us in a good position for retirement. So with that, Matt, I'm going to pass it off to you. If you want to run through some of that intro conversation about IAMS, because I see we have a number of people on here that aren't actually doing business with us right now. That's great. So do a little quick commercial on IAMS, and we'll be passing it off to our keynote.
You bet. I'm going to keep it short today. Thank you, Chris. Thank you, Ed. Thank you, Kent, for joining us. And thank you most of all to our producers. I'm going to keep it very abbreviated as compared to normal, but there are a lot of reasons that people like to work with us at IAMS. And 38 years ago, when Charles Hiring founded IAMS, he founded on a foundation of service. And everybody will tell you they excel at service, but we really do embody that. Hopefully you don't hear the phone ringing too badly in the background because it has been pretty constant, but we always answer your phone calls with a live person. We always want to help you out immediately whenever you need something. We've got a great team of people. They handle our back office and creative support. So one of the main reasons is our new producer bonus. When people work with us, you see some of the different thresholds you can hit during your first 6 months contracted with us. FIA business counts dollar for dollar. Life insurance counts 10 to 1 in a lot of cases. And MIGA business counts at a reduced rate, but our new producer bonus allows people to get a fast start with us if you're writing business, and we can reinvest in your practice to help you get more darts to throw at the board. We definitely want to take the opportunity to do that and keep your sales funnel full for 2024 and into 2025. So that's one of the big ways that people take advantage of working with us here at IAMS. Just like you guys, anytime you're referred a new client, that's typically the warmest introduction that you're going to get to a new potential client. You're our clients. We really value those referrals. So if we're doing a good job with you And you can help us out by referring one of your friends, who we can also help out by offering the same services to somebody you know in the industry that could tap into what we do here at IAMS. It could be a good mutual beneficial partnership for everybody. We want to pay you not only $50 when they first get contracted, but an override on any business they do. So as an example, if they write a $100,000 FIA policy, we're going to pay you $200, and that continues indefinitely as they are contracted with us, and you are as well. Our back office support team, guys, they are the tip of the spear in the industry. I've worked at several different IMOs. I worked at one of the IMOs that kind of people branched off and started all these different groups that are out there now. I know Kent knows personalized brokerage services from back in the day. I know Chris does as well. But I was a little younger than those guys, so I didn't get in at the ownership level with some of those groups. But I've seen what the industry has to offer, is what I'm saying. And I've worked at a couple of those different places. Our team of annuity support agents and life support agents are the best that I've seen. They understand what each carrier requires and help you overcome obstacles before you get there. But when something does come up, they're very good at taking it off your plate and helping you stay focused on the producers, or excuse me, focused on your clients, helping them out rather than working on all the administrative stuff. So Michelle and her team on the life side, Mackenzie and her team on the annuity side are fantastic in that regard. Our creative marketing solutions are, we do everything from business cards and stationery all the way up to getting you on the radio, on TV if you really want to. We can meet you where you're at and help you accomplish everything and in between. If you haven't had a comprehensive marketing analysis done by your sales consultant, by your marketer here at IAMS, we would love to spend the time with you, understand what your goals are, and help you back into the marketing solutions that will help you achieve those goals and exceed them. Please take the time to sit down with us and do that. It's free, and everybody has found huge value in that when we do that for people. We are big on paying back our producers. When you do business with us, not only are we going to invest in you from a marketing standpoint, we want you to feel valued, and we love to incentivize our producers by taking them on cool trips like this trek to Quebec that we're qualifying for right now. Is going to be another fun get together for our IAMS producers, a great opportunity to learn best practices, sales processes from other top producers in the industry. It has really become sort of a fraternal group of people at the top of their game, and we would love for you to join us out in Quebec. Just so you are aware, over the next couple of months, Athene business counts as double towards this trip and towards an Athene trip actually as well. So with that, I will pass it off to Ed. Ed, so happy to have you join us. Really excited to hear what the future holds for us and what some of the indicators are on the VIX and the, is it called the VIVIX? Is that how it's pronounced? The VVIX,
yeah.
okay.
Yeah.
So I'm really excited to hear what you have for us today. So with that, please take it away.
Sure. Thanks, man. All right. So basically, my job is that of a volatility options and derivative strategist. And yeah, ultimately, what the options market and the volatility market is in the business of doing is pricing risk. So what I thought I'd do today is convey to you, the major risks that the option and volatility markets are currently grappling with as we head into year end and going to next year. So to start off with, I'm just going to do like a quick state of the markets, right? So let's quickly look at the S&P, which is basically like what we use as a broad indicator of the markets, right? So Matt, could you bring up the S&P?
Yeah, you bet.
Yeah.
Here we go.
So what we see here is the S&P is at all-time highs, right? And there's a natural relationship between S&P and VIX. So you think of the VIX as either a measure of risk or a measure of market stability, right? So normally, like when the S&P is rising, you see the VIX fall, and normally when you see the S&P fall, you see the VIX rise, right? So let's take a look at the VIX right now, right? And you know, with the S&P at all time, oh sorry, that's the VIX. Yeah, but with the S&P at all-time highs, what you would naturally expect is that the VIX is near all-time lows. But what you've seen over here is that that's not really the case. So if you kind of remove out that big pop on August 5th, what you're seeing is that the VIX is actually like kind of on the high end. It's been trading around 20 for the last couple of weeks. And that's been a source of confusion. Like, why is that? Well, part of the reason why is because the VIX is not just descriptive of the current risk environment, it's also meant to be predictive, right? And what this is symbolizing is that, okay, well, option traders are pricing in a number of risks that are currently being played out in the markets, right? So the major risks that the option markets are looking at right now, obviously one is Q3 earnings. So we're right in the middle of Q3 earnings. At this point, 126 companies have reported out of the 500, and we're seeing like some downside surprises with respect to sales for a number of sectors. We're seeing downside revenue surprises for energy, utilities, materials, industrials, right? So these are our core sectors that are vital to the economy, that are basically like are being disguised by the fact that S&P is heavily weighted toward tech, which is currently in the middle of reporting right now. So that's one thing. The option market is currently trying to assess the outcome of the implications of the U.S. presidential elections. It's very concerned with something called cross-asset risk contagion, which means that it's very concerned from an equity market perspective with respect to risks that come from other markets. And the reason why is because, if you think back to the last 25 years, some of the largest stocks to equities have come from other markets. Think the global financial crisis, the Asian contagion, FX markets, you got the sovereign debt crisis. So a lot of times you have shocks from the oil markets. So that's another thing that equity markets are contending with. And finally, I'm going to briefly explain how option traders are positioning into year end. Okay, so I'm going to jump right to the U.S. presidential elections because that's a major catalyst for us over the next 2 weeks. And this is something that I haven't really displayed to you guys, but in the same way that interest rates have a yield curve, have a term structure, the volatile markets also have a term structure, and generally it looks very similar. It's generally upward sloping, right? So the near-term options have a lower volatility, and the longer-term options have higher level volatility. And normally, it's a very smooth curve. But what you're seeing in the term structure now is that there's a huge spike on November 6th, and that corresponds, of course, to the day after elections. And the amount of that spike is currently 2.5 vol points, which is basically double that of what we normally see going into the presidential elections. But what that means is that option traders are more concerned with this election than they have in other elections in the past. And we've done some analysis to try to figure out why that's the case. And usually the reason why is because different presidents have different policy agendas that affect the sectors, which cause sector rotation as they move on to office. But the analysis that we've done was to say, okay, well, yes, certainly there are policy differences, and the main policy differences lie primarily in healthcare and and in energy. But the thing is that like those differences don't really translate to activity on the S&P, and the reason why is because for the most part the S&P is dominated by the technology and financial sector. In third place is healthcare, but as far as the markets are concerned, both candidates have pros and cons with respect to healthcare. Trump would favor big pharma, whereas Harris, for example, would favor healthcare providers. The main point of differentiation is in the energy sector. So obviously, like Trump would favor the current big oil fossil fuel producers, and Harris would favor alternative energy. But that's not really what's driving that big 2.5 point volatility increase. The driver of that really is the concern that there's a disconnect between the polls and the results, that we might see nationwide protests. So at this point, Trump is leading in a number of different polls. The one that I focus on is Nate Silver, which shows Trump leading by 3 points. Now, bear in mind that, of course, that's still within the margin of error, right? But nonetheless, that's a big shift in sentiment from 4 weeks ago when we saw Trump behind by 3 points. And the second data point we look at is the betting markets. So predicted is one of the bigger betting markets, and that has Trump leading by 10 points. So we can see some concern there on post-election day, but we're also seeing elevated levels of concern for volatility going out 2-3 weeks, and that's not normal. Normally, what we see is a dissipation in volatility right after the elections, right? That vol premium just kind of goes away. But what we're seeing is high levels of risk, high levels of concern going out into Thanksgiving. And the way that we're kind of translating that is that basically is the risk premium for the possibility of a contested election. Now, one thing that we asked was, okay, well, is 3 weeks enough to kind of resolve a contested election? And looking back in history, we've had two in the past. In 2000, we had Gore versus Bush. That took 5 weeks to resolve. And about 100 years ago, we had Rutherford Hayes versus Sam Tilden, and that took 5 months to resolve. So basically, the bottom line is that we believe that in this case, the option market is maybe underpricing the risk of a potential contested election dragging out well into 2025. To kind of quickly answer, the reason why the VIX is so elevated relative to historics. Well, one of the reasons why is because the VIX is currently pricing in a high level of geopolitical risk premium. So you kind of see it play out over the last month, where we've had quite a number of tit for tats between Iran and Israel, and every time we've had escalation in their activity, whether it be Iran shooting like 200 rockets over to Israel, and Israel saying, well, we're going to retaliate by bombing oil fields. And then Iran says, well, if you do that, then we're going to disable the global energy infrastructure. Every time that we've had news on that front, we've seen the VIX tick up and price in an additional risk premium. Now, the one thing that that we're very concerned with is something called a VVIX, which you alluded to, Matt. So Matt, can you bring? Okay, so if the VIX is primarily focused on the concern for moderate down moves in the market, right? So what we're thinking is, so the way we kind of think about it is that the VIX prices the possibility of a 1 to 1.5 standard deviation move in markets downwards, right? But there's another index that we use to kind of to price in what we call tail risks. And tail risks are basically moves of 2 and 3 and 4 standard deviations lower than current levels. So what you're seeing over here is that the VVIX has been rising over time. So normally VVIX levels around 80 to 90. You kind of see that on the graph for the first few months of the year. Those are normal VVIX levels. So basically what that implies is that, okay, well, we don't expect any tail risk at all. We sense a very low probability for a downside shock, right? A major downside shock. But look at how the VVIX has been behaving since August. It's basically like exploded, right? So it's actually surged at this point to 110, 115, and basically like what the option market is saying is that like the possibility of a downside market move in excess of 2 standard deviations is much higher now than it was a few months before. So I would say that overall, both measures, the VIX and VVIX, are saying is that like as we look forward in time, we can expect higher volatility and the higher possibility of a move in the markets to the downside. Now, there's one final thing that we kind of like addressing as we move into year end, which is how traders are positioning for the year end and close. Normally you see basically like fairly modest moves in options activity as we move into year end. What we're seeing this year is a lot of purchases of downside convexity, which means that like traders are buying a lot of deeper out of the money put options to protect against a downside move. So overall, I would say that the volatility landscape right now is one where we're moving into a period of higher fragility, meaning that there are more macro and single stock level risks on the horizon over the next coming months, and it looks to us that it will take at least a few months to resolve the ones that I've listed at the moment.
And if I could ask you a question real quick.
Yeah.
This is Kent, by the way. Hearing all this and basically seeing that the outlook is looking like there's going to be more volatility. So when the volatility is up, correct me if I'm wrong here, but that means the cost of the S&P 500 option that's put inside of index annuities goes up as well. Is that correct?
That's right. Yeah. So basically, there's a direct linkage between the price of an option and volatility. So the higher the level of volatility, the higher the level of options. And keep in mind that the one bizarre thing about volatility is that it moves in an exponential manner, right? So like so you can have volatility surge as you see in the graph of the VIX, right? Matt, can you go back to the VIX? Did you see that huge shock from back in August, right? That was the yen carry unwind that occurred August 5th, right? So the day prior to that yen carry unwind, the VIX was 23, and then on the following morning it was 65, right? Wow. So yeah, so what that means is that like there's a possibility that volatility shocks, and if volatility shocks, of course, what that means is that the price of S&P options will basically, in this case, triple.
Wow. So if the price of the option goes up on the S&P 500, that basically means that the insurance carriers are going to have to lower their par rates.
Right.
Because
exactly.
To make up for that extra cost that the VIX is causing with that extra cost of the S&P 500 option. So that's kind of what we're trying to relay to you guys today is the VIX, if it goes up, that means par rates are coming down. And that's going to really play into what we're going to talk about with the sales idea we're going to share with you in a minute. So,
Yeah, yeah, I
wow.
was similar kind of thought. It's Ed, great insights. I love it. Love the charts. Kind of what's going on, and you made the comments like, well, traders are they're buying more puts effectively, so kind of protecting the future here. I mean, effectively for an average consumer, Matt and Kent, maybe. I mean, isn't that what they're doing by buying an FIA since they don't have any downside?
Exactly. Exactly.
So you think
So,
about that, and you think about that S&P allocation, which so many people do. I mean, I don't know if I've seen an application without a portion of the money in some form of an S&P, but if you got S&P allocation and the volatility today, it's like the trend has been low. I mean, for until recently, he's been really low, right? For the course of the year, but it's kind of spiked up recently. Um, to more historical trending numbers. You got a couple things going on there. As Kent mentioned, as it gets pricier, the carriers have to spend more money for the equivalent, offer to the consumer. So think of like a 50% participation on the S&P 500 per year gets more expensive generally in the marketplace as volatility on the S&P 500 increases, which is exactly what we're saying. The other interesting phenomenon. So what goes into a carrier's pricing for what they can price. Put on my sales hat when I used to work at a company. Well, number one is how you got to play with. And a lot of that, a good proxy of that is like, well, what are triple B bonds, which is like 2/3 of the money invested by the carriers. Well, what's that done? Well, it's come down about 130 basis points in the last, I don't know, 3-4 months. So you got less to start with, less pot to, kind of bet. And then if your bet costs you more, it's like a double whammy, right, Ken?
exactly. And
So
Chris, you worked at a carrier. Is the carrier just going to eat that?
no, well, I mean, maybe, I mean, you got to keep, want to keep your sales volume on. And that's why, Matt, I know you and I were looking at this, is like how many A-rated companies out there had like even 50% par rates on annual point to point. I don't know, a couple months ago it was a lot more, right? What are we sitting at, maybe 1 or 2 this year right now as we talking?
Yeah, A- rated carriers, I think we found 3 A- or above, straight A rated. I think we only found 2 that had a rate, and that's just an intro rate. And with this sort of volatility, how likely is that to actually
Yeah.
maintain throughout a contract? It's very, very low.
Well, let's then talk about. I know we got 28 minutes in here, but what's a good way to kind of lock in an S&P allocation, on an uncapped basis. So we like par. I personally kind of like par because if the S&P runs, you want to get as much as you can, right? You don't want to get capped out at 7, 8, 9 or something, right? You want to capture. That's the whole idea of the upside. But if we're looking at a forecast potentially of less returns, and I don't know, Matt, have you ever had a call from an agent saying, "Boy, why did the carrier drop those pars and caps?" I mean, you ever get that call? Probably every day,
I
right?
think that's probably one of the most consistent challenges that we overcome is helping producers have that conversation with their clients. I think most people here would probably have been impacted by the S&P rates changing within the contract. In fact,
Yeah.
that was one of the polls that I had. We have 3 quick polls. I'm kind of curious with the group here, how many people have seen a rate drop on the S&P 500 with their clients. So we'll just leave this up for a couple of seconds, but love to hear your feedback there.
I think I had one today.
I think I've had a
So,
couple.
we get that a lot. I'm guessing a lot of people are checking yes there. But Matt's going to share quickly kind of an idea with a brand new proprietary product we have, A-rated company, and that has a way to lock in your S&P allocation, your uncapped allocation for the full term of the contract.
Sure. And guys, I apologize about the phones. We've got a brand new phone system just today. So if you hear it ringing, I'm shutting it down as quickly as possible. But apologies about that. So SBLI is an A-rated company, has been since the inception of credit ratings, straight A-rated with AM Best. And we developed a partnership with them because we saw an opportunity. Since the S&P is used so often, it's a familiar story for our agents and their clients to really build something unique in the marketplace. We saw clients looking for a guarantee, a minimum guarantee, compounded annual return. And we also saw an opportunity to give them some upside and find that sweet spot for clients. So the SBLI Market Crest is a product we developed. It comes in a 3, 5, and a 7-year chassis. And the main selling features of this product are that it provides a minimum guarantee. On the 5-year product, for example, you're going to get 4% worst case scenario every year for your client, but you get 60% of the upside of the S&P as well with no market exposure. Your client is going to get whichever is better over the length of the contract, and they get to capture the highest policy anniversary value. So if let's use 2008 as an example. If you were in a product like this and you purchased it in 2004, in the third year, 2007, the markets are up significantly. But then 2008, they take a dive and they're down in 2009 also. Well, you would capture 60% of the participation on the policy anniversary in 2007 before those markets went south. And it's likely, I haven't looked at those particular numbers, but it's likely that that would outperform the 4%. In fact, what we found is over the last 10 years, that 4% hasn't even come into play. When we look at the values over the last 10 years, this particular product, and I've got a great dot chart to show it here, has been up above that 4% mark 100% of the time. If it was purchased on any of these dates listed down here, we have this that we can share with you guys. That gray line represents 4%. The blue line represents a 5%, which is really kind of the best rate you can get with an A-rated carrier right now. Most A-rated carriers will give you a MYGA below 5% right now. This outperforms a 5% MYGA 95% of the time over the past 10 years. That's a pretty powerful story. And you're still providing that 4% guarantee for your client. The average annual return over the last 10 years, this green box here, 7.7%. That is absolutely fantastic. So really strong product to provide security for your clients, downside protection while maintaining a guaranteed minimum of 4%, which was a fantastic rate. If you came to me 3 years ago and said you could get a 4% guaranteed return, everybody would have jumped on that. But it's still giving them significant more opportunity.
Yeah,
Chris?
Matt. Yeah, great. Thank you for that. And then I'm going to pass it off to Kent here, kind of, sales concept. But 2 quick things on this, everybody on this call, is I think of this as the sleep annuity from the no apologies company. The sleep annuity with the no apologies company. Why do I say that? Because you can sleep well at night. Worst case scenario, your client's going to get what historically the last 10 years has been a pretty good MYGA, a 4% guaranteed compound MYGA rate. So at 100 grand, they're like 121, 600, 5 years. Worst case scenario. There's nothing like that out there. I mean, this is kind of combining the best of both worlds. Plus, if it's greater, 60% of the highest anniversary value. In fact, on the 7-year term, Matt, you get 70% uncapped S&P 500 highest anniversary value. Sleep well at night. No apologies company. Been around 117 years. Never less than A-rated company. Mutual company. So we really like the partnership there with SBLI. It's a very transparent, maybe the cleanest annuity product I've seen in the marketplace. I did an interview, I know, with Insurance Newsnet about this, and life and annuity specialist too. And it's just really simple. Explain, 30 seconds on elevator was the idea. So we like that. And then Kent, I know you were out here for our training academy, which if anybody's ever interested, shoot a note to Matt. We'll get you on. But Kent was out talking about Indexalizer and Reviewalizer, some other tools. you came up with a heck of an idea that I want to pass off over to you. There's the rate sheet for Market Crest. Again, that 357-year chassis, competitive commission if you want to do a kind of a back-to-back scenario. But Kent, I'm going to pass it up to you because you got some great tools. We talked about Splitalizer, and this is an example, I guess, Matt, and Kent, where typical client might take a portion and put it at, say, S&P par. And why would this be better?
Yeah, so basically the concept is you see the chart there. This would be like a normal allocation of a SILAC annuity. And understand, we're not telling you to not sell the SILAC annuity because you got some great vol control indices in there. But right now the S&P 500 is on sale. You got these super high par rates. You got unbelievable opportunity to make money in the S&P. But as Ed Tom just shared with us, as that volatility rises, you got to be conscious of what those renewals are going to look like. And those renewals, if the VIX keeps running, are not going to be that great. So go to the next slide there, Matt. So if we took that 30% that you would allocate to the SILAC S&P option, which is a much lower par, okay, what we're going to say is let's don't keep that at SILAC. Let's move that out and send that to SBLI. So in other words, we're going to split the ticket. Okay, so we send that to SBLI and we go 100% into the S&P with that 30% of the client's total premium. And then there you're locking in the 60%. So back at SILAC, we take that 30% out. So we just added 10% to each of the other allocations. So we've got, 45 in the next gen 5, we got 35 in the Duo Swift, and then 20 in the Raven Pack. So now you have a very, very, very good allocation strategy for the client's money, but we're not going to use the S&P option in SILAC. We're going to put that over to SBLI. So can I go ahead and share my screen now? Give me the option to do that, Matt.
Yeah, do you have the option now?
I don't see it. I don't see it on there.
Everybody's named Ed Tom here, so I apologize. We had a little snafu with the
There we
invitation.
go. There we go.
Okay.
So let me get this shared here. So out on our website, which is indexalizer.com, it's the Elizer suite of products. This is an IAMS only. Are you seeing my screen now, Matt?
Yes. Yep. We're good.
Okay. So this is an IAMS only. We have this special thing over here called Splitalizer. So you can actually watch a video on it, but then you can download the actual software where it's an Excel spreadsheet right now. But you can download this and you can run an example of exactly what this would look like. So let's say you're working with 250,000 and your allocation is, let's say, 33%. So if you were looking to do that in your product you like to sell, like we're talking about, SILAC, the Teton, instead of keeping that 33% at SILAC, we're going to bring it over and capture the 60% par rate that's locked in over at SBLI. So if your other product, again, is SILAC, you type that in, and then we look at the Teton, and then the par rate right now. So what you're going to do to get that par rate is go back into Elizer here, go into Indexalizer, and you can go out here and just quickly put in your state, your age, your 250,000, and then SILAC, and then choose that Teton 10. And then we're going to view the report. So we're going to come down here, and all we're looking for is that S&P par only option. Right there it is, the 52%. So now we're going to come back here and plug that 52% in as the par rate for the SILAC Teton. Now, here's where it gets a little different working with us. That 52%, that is the current par rate. But we want to look at historical returns. How can moving that money over to SBLI get your client better returns? So we got to look at history to see how we can show that it would be better. So when we're looking at history, guys, we cannot use the back testing that's inside the illustrations or the back testing inside of any other software because they're using today's par rates up against the last 10 years. A client will never live through that. A client doesn't buy an index annuity, hold it for 10 years, and then have the carrier calculate what their par rate would be. To do an accurate back test, we need to know what the par rate was 10 years ago. So there's a special thing you can do inside of Elizer that you can't do anywhere else. So when we pull this back open, there's this little button here called retro pricing. You turn that on, and what happens is there's an actuarial algorithm that's going on in the background that's going to reduce those pars down and show you what the par rate would have been 10 years ago, so we can do an accurate back test. So now we know that that's 20%. We're going to plug that in here as the retro pricing, and then we're going to put a drawdown in. Now, what's the drawdown for? Well, when we're looking at the last 10 years, sure, we know it started at 20%, but because of things like you just learned from Ed Tom, if the VIX goes up or if fixed rates come down, they're going to lower those rates. If you've been in the business for any amount of time, you know that this happens. Okay, we just took a poll. You've all seen rates come down in the S&P. So we're going to put in a drawdown to simulate that over the last 10 years, because it would have happened. So now what we're showing is, if you look at this chart and look at this table, the SPLI, with how it uses that high water in the first 5 years, it would have done 10.35, where your SILAC, just the S&P side, would have been at 5.22. Then you would have kicked in another 5 years. So you're going to resell it, get another commission, and you're going to look at the last 10 or the last 5 years, which is 30.27 versus a final 16.77. So the bottom line is, guys, the SPLI wins by 1.2% per year. So it makes a difference on a case of size of $9,690. Now, you might not think that's a lot, but it actually is. That means a lot to somebody that only has 250,000. But the other side of it is what Chris said. You know, they'll be able to sleep at night. And you going back and doing your reviews, you'll never have to talk about that 60% coming down, because it's locked in. Where if you would have kept the allocation at SILAC, you're probably going to go back and show rate reductions. Is that VIX runs, like Ed was talking about, it makes that S&P option more expensive. They're going to lower that par rate on your clients. With this SPLI, it stays at 60. So this just proves mathematically that the client can't lose. That's literally what this proves. Because the one thing we do know is this 52% at SILAC. Now, that'd be another great poll question, Matt. How many times have you ever seen a carrier raise those rates? You know, that's rare, man. That is really rare. So you know you're going to win because you're the 60 versus the 52. But we wanted to go a little deeper and show you, based on history, that it's actually a really big win for SPLI. So, guys, this concept, this split ticket, I know you might be thinking, all right, what's going to happen to my commission? Well, it's actually going to be better. Even though the SPLI is a little lower than what SILAC is, okay, remember, you're going to rebuy in year 5. So now you're getting another commission, and it's not just on the original amount, there's growth there. So you actually could, over a 5-year period, make more. Plus, then think about liquidity, okay? If you have in year 5, you know, if the client needs to get their hands on money, that money that's at SPLI that's in the S&P allocation is now completely free and clear until you do the rebuy. So now you just increase liquidity tremendously for the client, and the clients love to hear that. So not only does it do better for you on a growth mechanism, it adds an extra liquidity feature, and over a 5-year period, it actually pay you more. So this concept is really a simple concept. We've kind of made it a little more complicated here, but we did that on purpose, because you're going to be selling to clients. Some are just going to want to hear, okay, 60 locked in is better than 52 that could go down. Done. Those clients, that's all you have to say. But you're also going to have your engineers, your business owners, your doctors, you know, the more astute clients that are going to need to see some deeper numbers. So that's why we created this little tool for you and made it part of the Elizer. And again, guys, this is just for IAMS. So if you have Elizer through somebody else, you're not going to get this. So you want to move your contract over, your subscription over to IAMS, because it's the only place you're going to get the split Elizer. And that can, oh gosh, could make you so many sales. It's definitely going to give you happy clients that are going to refer you. And it just makes sense. When the math makes sense, you got to do it. You got to do it. It's going to be better for you, better for your clients.
Yep.
You just can't.
You and I were at that same conference, the National Association for Fixed Annuities annual conference, just a couple weeks ago. You remember the great presentation we had from the keynote that was talking about building trust and credibility. And I know he talked about, having research-based tools to imbue that credibility and trust. It's all about credibility and trust. So, we're not trying to say overcomplicated. This is not complicated. Talk to Matt. He can walk you through. We got a lot of agents onboarded with a Realizer. Splitalizer, we think, is the almost mathematical proof. It's your DOL fiduciary rule, best interest proof that what you're doing is best for the client. So we're excited about that. Only available here. We're the only ones who have that product from A-Ray Company. It's great. We actually really, really like Silac and the Teton 10 product. We're not saying anything negative there. We're just saying, in fact, we love the ball control indices there, the Raven Pack and Next Gen 5. And Next Gen 5, I think, is probably the best performing VCI, right, Ken?
Oh, absolutely,
So
absolutely. I mean,
we love
yeah,
the Barclays. We're not saying do that. We're not even saying anything negative about Bar or
no,
what we're saying is, if we can offer your clients a better solution to lock in S&P par, which a lot of people understand and trust, if you're going to do it anyhow, why not lock it in while it's cheap with a no
well,
apology company? I think of it as like sleep insurance, but Matt, honestly, hell, I can sleep until 10 o'clock and let you do all the work. If I knew 10 years, and it's just that easy. So I like that. And liquidity. So I know, Kent, you went through that quickly. If anybody's on this call, they want to understand what he's talking about with greater liquidity, Matt can walk you through it. The point is, yes, liquidity is important. We're always about profiling the money, and kind of crafting a solution. But here, you could actually get far greater liquidity than if you had it just in one product, where it's typically a 5 or 10% free withdrawal. You're talking about 100% free withdrawal at the end of that term, that say 3, 5, or 7 year term. Great option. Matt, bring it home.
Yeah, Kent, thank you. I mean, that's a fantastic tool. If you guys missed it, I did launch a poll. If you'd like more information on Indexalizer, Splitalizer, I'll teach you how to use it. We do a bi-weekly webinar where that's all we focus on, is teaching agents how to effectively use that tool in a sales process and become familiar with it. But
And
we
Matt,
just want to give you more opportunity to be
are we
comfortable with that, to sell it, and to offer something to your clients that they can't find anywhere else. This is a differentiator. It's only available through IAMS, and you're going to outcompete other advisors with tools like this, with products like this, for sure.
and we're running a, aren't we right now on that? Aren't we doing a subsidy deal with those?
Yeah, it was already the best deal in the industry. Indexalizer, and you also get a very strong client-facing sales process, sales tool called Journey Guide. If you've used Retirement Analyzer before, if you've used Retire Ready or the Track program before, it's kind of the same sort of thing, although I think it's actually presented a little bit better. You get both of those tools, about $150 per month value, for $25 if you're contracted with us here at IAMS. We have a very unique partnership with Kent and his group, and then Michael Smith and the Journey Guide team as well. So fantastic value there.
yeah. And if I could say one last thing too, guys, there are a lot more resources on Elizer for you as well. This is one that is specific to IAMS. And I can't speak enough about how much I love this. Like Chris was saying, guys, we're not saying that the other products aren't as good. Okay, it's not about that. When a product's put together, they're all built differently. The Silac product's built to have all those different options. Okay, but to have all those different options, there's more cost, and they can't give you the higher rates. What they've done at SBI is they've laser focused in on that S&P 500 and created the best option there. So, that's why it's not necessarily that it's a better all around product. It's just better at the S&P. And one thing, I want to add in, guys, that we forgot to mention is protection. Splitting the ticket, you get bigger cases. Okay. You got to remember the Guarantee Association. I know you're not supposed to use that as part of a sales concept, but it's still there. And if you're splitting your ticket between companies, you just doubled your protection amount for that client. So you want to check what your limits are in your states, but that's another benefit of splitting the ticket, is getting that extra protection. So I want to thank you guys for having us on today. Guys, this stuff can really change your business and really make you more money. And there's so much more. And like I said, give Matt a call. He can walk you through. We got webinars coming up. You can learn more about everything that we do. So, all right,
Well,
guys. Well, thank you so much.
yeah,
Yeah.
Kent, thank you so much. And Ed, really appreciate your time today to hear from you and kind of what's to come there. Thank you so much. I know we got a lot of people in this program, so we'll follow up with you each on some questions that you might have had. And but I thank you for your time.
Yep. We do have just a couple of questions and comments here if you guys have time. I know, Ed, you had a hard stop. Let me just read through these real quickly here and just make sure that we can answer any of these that are quicker questions or comments. Robert, SBLI does not reduce par rates within the contract. Those are guaranteed rates. So just wanted you to be aware of that. It is filed as a MIGA. Somebody asked that. So if you are a registered rep or you are just in a situation where for whatever reason you can't write FIAs, this is registered as a MIGA with a rider to get that participation rate on the S&P 500. So it is filed as a MIGA. And then,
Pat,
yeah,
I know
go ahead, Chris.
broker dealers approve that too, as accordingly.
Right.
So,
Yeah, it's gained a lot of traction in the BD space. In fact, we expect that to be one of the main areas where we're going to have a lot of business coming in from. Let's see. A longer question here. I'm going to read it out for you, Tom, and maybe you can address this. How are the costs of the VIX call and put options managed throughout the trading day or month to ensure that they stay within the expected strategy corridor? And then the second part to that question, specifically how do market makers, implied volatility, arbitrage opportunities, and risk management techniques can contribute to controlling these?
So I guess the question is like, how do market makers affect the pricing of the VIX to make sure that it's fairly liquid and stable? So basically they use models, and specifically with with the VIX options, they in the model there's something called a convexity adjustment, which is basically pricing in the possibility of a huge tail shock. So generally, like market makers have essentially like a database, if you will, of potential known unknowns, basically like expected events that are likely to shock the markets, and they will basically adjust the volatility surface for the VIX options accordingly.
Great, thank you. One last question from Craig. Craig, you asked about when can we have IAMS reps help us with the proper blend so we can focus on sales and not the drill down strategies. That's a really good question. We get that quite a bit. And the way I'd answer it is we can tell you, what's performed. We have the tools to talk about those allocations, and Indexalyzer specifically is the best tool to show how different indices have performed historically. But from a liability standpoint, and Chris, correct me if I'm wrong here, I don't believe we can actually make the recommendation for you. In fact, as a producer, it's my understanding that your client needs to pick those allocations based on the input that you give them. I know that's not the way that everybody does it, but Chris, maybe you can provide a little feedback there. And certainly, Indexalyzer is a great tool to do the research to find that out.
And Kate, you probably have some insight on that too. I mean, I think there's lots of tools out there, right? And it's our job, you and IAMS and Kent, to help you with the client figure out what is that right decision. Ultimately, that client is the one who's choosing those allocations. I do know we have producers, for which the client has actually kind of delegated such authority to them, and then they'll confirm it with the. But I don't think it's intentional allocation. If you know, another part of the puzzle that help you simplify decision making. I know, Kent, you have a lot of people tools for allocation recommendations.
Yeah, actually, Matt, could I show my screen real quick? Because I think I can give this guy a great answer real quick. There we go. So, are you seeing my screen now, Matt?
Yep.
Okay, so inside of every Indexalizer report, guys, down at the very bottom, we have an allocation consent affidavit that basically you get the client to sign, and it basically says the client represents that they are using the information in this report to assist them in making their own choices pertaining to the allocation of their index annuity. So we literally give you a form that you can have ready for a client to sign saying that they made the choices. Okay, now that is important, but you still need to guide and direct them. So when you have your Indexalizer report, all you have to do is go down here to our diversification optimizer and put it right in front of them and say, here you go. Here's a whole bunch of different diversification options. Pick the one you like the best. Done. It's really that easy. If you have access to this, you can literally just show them a whole bunch of different allocations. You can even do some custom ones and then just let them pick what they like. Now you're compliant. You did your job. You gave them the research, and now their job is to pick which one, and then you can actually have them sign and say that they did that. And now you're protected. You've used data to make these allocation choices instead of theory or guessing. And now everything's on the up and up. So if you get down the road and performance isn't that great, it's not your fault or your theory's thought or fault. It is on the data. And I would rather trust the data than any crazy ideas I get myself. So that is built in and to help you really understand that you do have access to a tool. You can do it yourself. It is so easy, so easy. And then if you have trouble or you need something more, then you got your whole team at IAMS to help you.
Excellent. Thank you, Kent.
Other questions, or?
That's it for today. So
Well,
All right.
I'll tell you this. I don't know. For you that like to read, like the book Black Swan. I don't know if you know that one, Kent, or maybe you do, Ed. Famous options trader Nassim Taleb, who wrote Black Swan, and I think he was talking about kind of the crazy stuff that could happen in the markets, right? Um, Black Mondays and everything else. I think I'd rather have the Swan investment strategy like we're recommending, not the Black Swan. Sleep well at night. I'd rather have Swan insurance as opposed to the Black Swan.
Definitely. Definitely. The idea behind it, guys, is use data. Use that you just you can have your theories, have all this, but use the data. The data at least tells a story that you can validate. Okay, and don't get into making projections. That's the whole idea behind Indexalizer. It's not about making projections. It's showing you what happened in the past so you can show your client how each option did and they can make their choices. It's that simple. It really is. It doesn't need to be that hard. You can just let the data do the job for you.
All right.
all right.
Well,
Thank you so much, guys. Really appreciate it. Ed, special thank you to you, and we will see you guys on the next webinar. Take care.
Thank you.